Well, Jay Pestrichelli, the CEO and founder of Zega Financial, and options and ETFs are like two of the top topics that, we see people searching for, want to learn more about.
I love it.
Benzinga, you're like the expert in both these areas.
I'm your host, Jason Raznick, founder of Benzinga, a leading platform in the financial world with the mission to level the playing field for individual investors. And this is the Raz Report Podcast, where we share inspiring stories, expert advice, and exclusive perspectives to keep you ahead of the ever-changing world of investments and entrepreneurship. Let's dive into the show.
All right, everyone, welcome back to another episode of the Raz Report Podcast. We've got a very special guest with us today, Jay Pestrichelli, the CEO and founder of Zega Financial. Jay, how you doing today?
Doing great. Thanks, guys, for having me on. Super excited to be here.
By the way, this is Aaron Bree, and I'm Jason Raznick. So Aaron, thanks for coming on too. We're excited to have Jay on. There's so much you're going to learn. If you ever wanted to know how ETFs work, what is an ETF, you're going to hear not the long-winded answers. You're going to hear what they are, how they work, how you can be successful with them. And you know what I'm going to start it off with, because this is the question that historically older people would say, why am I going to buy an ETF? There's mutual funds. There's like 60,000 of them, it feels like. Why would I buy an ETF versus a mutual fund, Jay? That's what I'm just going to start. We're not even going to go to your background yet. I just want to.
That's great. Yeah, let's just hit it. What's the difference, right? Because a lot of folks will treat them as interchangeable investment options. But as the name suggests, in an ETF, that stands for exchange traded fund, which means they trade on exchanges. And so you don't have to wait for the end of the day before you're going to get your price, right? ETFs end up being traded throughout the day. Actually, quite a bit of volume across all the exchanges occurs in ETFs now. Mutual funds are a little different structure, but the beauty about ETFs are pricing is kind of based off of the underlying holdings within the fund. So you have creation and redeem functionality within ETFs. And while all that's boring, what it means is you can get direct exposure to an index, a theme, even active management, which is a lot of the stuff that we do. We even put options in ETFs, right? So you get a lot more, in my opinion, diversification. There's also some tax benefits when it comes to ETFs as well. So the dividends and the gains and those kinds of things. I don't know how many times I heard from clients when I worked at Ameritrade about, hey, I held this mutual fund, I didn't sell anything, but yet I got a tax bill, right? So things like that won't always happen to you with ETFs. So tax advantages, exchange traded, liquidity. You want to get out, you get out. You get out the price you like. You want to get in, you pick your spots and you can get in. So a much more dynamic vehicle.
And there's one thing you didn't mention. Aren't ETFs, don't they typically have lower fees, or is that not typical?
Sure, they can. Yeah, they are more efficient to operate. They can be, for sure. They could come along with a lot lower fees, for sure.
So then here's my question. And Jay, we're going to get into the options ETFs. Aaron and I were talking about that prior to the interview. My question is, let's reverse the question. Why would someone say a mutual fund is better than an ETF? Like, what would be the argument where a mutual fund is better than an ETF?
Well, it's not something we manage directly. We've had them before. I think you could get, some maybe less accessible products, right? A mutual fund doesn't have to hold things that are completely exchange traded, right? So sometimes if you want to have, a basket of things that are maybe less liquid, a mutual fund can hold those, where an ETF is kind of stuck to it has to be something we could trade intraday within the fund itself. So, private funds and things like that could all find themselves into a mutual fund. So I still think there's a use for mutual funds, but generally the market is moving towards more of an ETF.
That's what it seems like. And I just, I'm on the board of one of these pension funds, and we still have a lot of mutual funds. And I ask why there's not more in ETFs, just because the fee structure. And I just wondered how that is going to progress over the next 3 to 5 years.
Yeah. So Jay, here at Benzinga, we deal with primarily an audience of retail investors, and options and ETFs are like two of the top topics that, we see people searching for, want to learn more about. And I know that's like your whole experience is in ETF and options. Can you tell us, and also with retail investors, you were at TD for a while, helping, you were there while we had this whole movement toward people going from having stockbrokers and this stuff to having their own brokerages. What did you do at TD, and what did you see throughout your time there?
Yeah, I'm going to date myself a little bit, but yeah, I worked at TD for about a decade, ran the active trader business there. I left in 2010 before I started
Did you
my.
work with like Steve Quirk and JJ
Sure,
Kinahan, John
actually,
Hart?
yeah. So I was there pre Steve, but also when Steve came on board, Q we called him, is a great guy.
Yep.
At the time there with his previous employer, we were involved in that integration with the Thinkorswim business, right? So knew all
Tommy.
those guys and really kind of built the business before that as well. It's options have always been so interesting to the individual because it seems like literally you have all these different choices you could make. If when you hold stock, you could do what? Two things: hold it or sell it. That's about it. Options really give you a lot of different ways to manage through positions, repair positions, take advantage of upcoming things. And so it's one of those things that we saw a lot of retail, the do-it-yourselfers in the retail space, get interested in options. And so we made a concerted effort to educate and help people understand and then build and buy the tools that'll make them better investors.
So at Zega, do you guys do financial literacy for like options, or is it how you build products? Like how do you?
Yeah, all the products at our firm, we started out actually just managing individual wealth books, but everything we do has an options component to it, whether it's hedging, alternative income, risk-defined outcomes, all of those types of strategies we do on an individual basis. That was always kind of our niche. So yes, we do a little education. I wrote a book in 2010 about options. We were fortunate, went to #1 in the investing category. It was called Buy and Hedge, 5 Iron Rules for Investing. There you go.
So buy and hedge, that is my dream here. So let me just go to my dream for a second. Let's say I have a lot of Tesla. Let's just make a number. Hypothetically, let's say I have 400. I do not have 400,000, but let's say I had 400,000 and I'm up 200,000 on it. Okay. And they have and Tesla has earnings coming up. And I want to take off some stock because I'm afraid it's going to be down, whatever, but then I don't want the tax gain. I know there's a strategy where I could use options for insurance. And if it falls, then I still make money. Then maybe I sell some. But I don't think for you, Jay, you're an expert at options. It's easy for you, but there's not an easy button for me to click and say, okay, here's how I want to, what do you suggest that I do for that? How do I hedge my position, or what do you suggest?
Yeah, for you're right. For us, we love if you were directly, a client with us, then what we would say is, look, let's buy some puts or buy some put spreads that'll kind of give you a chance to reduce your downside participation. Really, puts make money when the stock goes down, so it's kind of the offset, right? Stock down, put up, kind of gives you the ability to maybe make something if it goes down, but it's not overly expensive. Yes, by the way, Tesla options are probably on more of the expensive side because it's such a volatile stock. And the price of the options is related to that volatility. However, it's still not, you don't have to take the tax consequences by selling. You're kind of building a little floor into your portfolio at a level that you're comfortable. In a stock like Tesla, you're probably comfortable with 10% swings at any given time, clearly. So, all right, so you buy a hedge for a couple weeks, 10% down. Maybe you're fine if it goes, it's not going to go down 50, otherwise you would have sold more. So, hey, you sell some of that away and pay for it. One of those things, those put spreads and long puts really help offset it. However, not everybody's even comfortable with knowing which expiration, which strike, how do I read all these Greek things?
Exactly.
So now you have other tools at your disposal, like inverse ETFs, right, where you can buy some of that to kind of, deaden the, the potential impact on the downside. Naturally, though, if Tesla did go up, your inverse would lose money. Whereas with the put spread or the long put, you can only lose what you pay. So if you decide to throw 5% at that protection, the worst is you could lose 5. With, if you decided to take, a third of your portfolio or, a significant portion and buy the inverse, you could lose, on the way up with those two. So I think it's, yes, the level of sophistication that you want to get to can help get a little better of a dynamic of a tool. But quite frankly, if everybody knew how to buy a put, volatility in the markets would be significantly lower. They just would, because less people would be trying to time markets, running for the doors. You could get even more complicated, but that is the most simple answer I could give you.
Okay, I know Aaron's excited to ask you about the whole white label sub-advising market and how that works in SoFi. So, Aaron, take it away. I know you were talking about that.
So, I mean, how exactly does this process work? Because, I log on to SoFi. I see one of SoFi's ETFs with SoFi's name on it. but then you're actually doing the active trading behind that ETF. Is that correct?
Yeah, that's correct. What we're known in that scenario is we're known as the sub-advisor, right? We're the kind of the options manager. My firm is the one that does the trades, right? We're clicking on it. We're the ones picking the option expirations. So our relationship with SoFi is they are the sponsor of the fund. It's their fund. They participate in the economics. They're the ones that do the messaging. They're the ones that pick the type of fund that they're looking for and the dynamics of how it fits into their portfolios. SoFi is, pretty engaged in building products for their investors so they could do it themselves. And, they want to bring stuff to the market that's unique. And the fact that they've added an options-based product to me says, that speaks volumes, says they're really committed to this. So they have, hey, Jay, we're looking for a fund that does XYZ. We then go ahead and build it, say, this is the parameters. Is this what you're looking for? They say, yep, great. And then together we launch the fund. And we say we launch the fund. It still is a SoFi fund. We just happen to be one of the multiple companies that are involved in the daily execution and delivery of that fund. We're the trading partner within it, but we're not the administrator. We're not the trust. There's a lot of different components associated with an ETF. But our role is more of the strategy and delivering on the goals of the fund's performance.
I mean, that's awesome for you, because I'm not saying this would ever happen, but say one of those funds goes down 50%, people are mad at SoFi and they're not coming back to you.
Well, I mean, we're listed, so that's true. I mean, we're listed as the sub-advisor on that. So in all of the prospectus and all of the documentation, it's not like we're hiding behind, the veil of SoFi. So, and we're out there, and usually when there's a press release, we get mentioned as the sub-advisor there, not because we're looking for the exposure. It's more of a disclosure piece.
Right.
So you're right. It's not our brand, but, I'm sure
what's an example on a SoFi platform of one of your ETFs that you work on?
Yeah, the one that we work with is ticker THTA. It's
THTA.
Kind of
Theta. Pulled up on the B-roll screen. Thank you.
Yep.
Okay. You can pull it up. Okay. And what is that?
This is an enhanced income strategy that is a basket of treasuries. And we sell options to generate additional income. The target of this strategy is to generate about 1% a month in option selling, and then earn the yield from short-term treasuries. Those the income we generate from the options will be distributed on a monthly basis, as a yield or distribution. And the idea here is to have a stable 10 to 15% return, where you're not experiencing a lot of volatility.
Hold on. Wait a minute. Back it up. Hold on. THTA. Okay. Can I only get it on the SoFi platform?
No, you could buy it. It's listed on the New York Stock Exchange.
But so I am in some fixed income, the treasury stuff, and it yields 5.46. Okay. That's what it yields. You're saying yours can yield 8 to 12%?
Yeah, and because of the option overlay, we could do that. And of course, there is, nothing comes risk free in that scenario, right? The treasuries are short term, so let's say you start with a 4 to 5%, yield from the treasuries, right? We all feel treasuries are fairly stable, I'm assuming. And then the option overlay of trying to generate 0.75 to 1% per month runs with a strategy that we like to call a high probability option strategy. Basically, we're selling deep out of the money options that have a very low chance of going in the money, and we get paid that 1%.
You're selling them to me.
Whoever's buying an out of the money put at 20%, 15% out of the money. Yep, we're selling it to those folks, right?
So,
and it's a monthly trade.
How long has this THTA been around for?
So this fund is fairly new, right? I think it's just a few months old at this point, but the strategy itself is one we've been running at Zega since we launched in 2010. So I've got a 12, 13-year track record on this particular very similar strategy to an SMA strategy we're running.
What was the return last year and the year before?
The return last year, well, that's a great question. I will pull it up here as we're talking about it. But I will tell you this as I'm pulling it up. The strategy itself has never had a negative calendar year. So the strategy is really just designed to generate this, like I said,
There's
this stable income, stable set of returns. So
a
last
reason
year,
why I was going to say there's a reason why when SoFi was looking to make this ETF, they went with you guys. You guys had this track record.
We had the track record, right? So when they approached us, we said, look, we've got, you're looking for an alternative income strategy that has stability, then great, we've got one of these. Yeah. So last year made 9%. In 2022, it made 5.5%. I don't know a lot that made money in 2022. This is one of those strategies that did. The average on this strategy is about 9 to 10% after fees within our advisor business. The fees are lower in THTA than what we charge for direct wealth management. So,
why has no one mentioned this to me?
Here we are
right now.
Here we are.
No, but like I hear you, but like, I'm literally, if I was in my account right now, I would buy a nice chunk second.
We'll go into your brokerage right after this.
Yeah.
So are we allowed to do that, Jay? Or since we talked to you today, we have to wait a few days?
I think this is no inside information being given. Let me tell you guys the risk of the strategy, though, right? Because nothing is free. And so yes, there can be risk here. Like any strategy, right? If you're going to have an increase over a risk-free rate, there's a risk somewhere. This strategy risk is what we call black swan risk. So you need like a 2020 pandemic scenario to really cause some volatility in this portfolio. So, but in that scenario, I'll give you, just a little data on that one. In February, now again, we're just talking about the SMA. We're not talking about THTA.
Right.
We're just talking about our sub-advised strategy that is very similar to the Theta one. In February of 2020, the strategy had a minus 24 for that month. Not worse than the market that, lost 35. But then the following month had a plus 19. So you can get some volatility when you have a really, I'll call it a black swan event. And I don't mean just a random black swan event. I'm talking like a 9/11 or a pandemic kind of
something
event.
You only see once every 20 years or so.
That's right. So
how much money is in THTA?
Today it's fairly small. I think we're under 15 million in the fund. But again, barely.
I'm missing something. Are there? Hold on. Look, I'm really stuck on this. Okay. Are there a lot of competitors at THTA?
There are some. I would say the actual structure with THTA is unique, but when you look at some funds that will have a treasury base and they do an option, active option over the top of it, there's some of those out there. SVOL is one of them. CSHI.
SBOL or SVO?
V. Sam Victor.
How does that compare to yours?
A little different in the the positions are more, volatility related in SVOL, but still done over a basket of treasuries.
Well, Aaron, here's my take, Aaron. I was saying, okay, I get off this podcast, I go buy $1 million of what is it?
THTA.
THTA. I own 8% of the outstanding. You know what I mean? Like, that's why I was like,
okay.
Yeah.
Because it is fairly new, right? And of course you don't, but I would tell you this is one of those beautiful things about an ETF we mentioned earlier. It's more about the liquidity of the positions than the liquidity of the fund itself, right? If you're worried like, well, if I got to sell this and there's a run on it, I don't want to sell 10% of the fund in a single shot. It's all about S&P options and treasuries, right? You will never, no single person is going to break that market. So,
and this pays monthly?
Yep. Distributions monthly.
On the option or the whole, so like my VFX, I get a monthly dividend, same kind of thing?
Exactly.
Okay, this is
so Jay. We've talked about volatility a few times. mentioning the black swan event.
Jay, I'll send you a print screen of my trade, but
nice.
I'll do it in doses. Maybe I should buy the SV, the other one, and this one, and then
we get
report back in 2 months.
Yeah.
Okay, that's what I'll do.
We talked about volatility, and I think that's one of the things where retail investors, you mentioned the COVID. How many people saw their retirement portfolios?
The COVID? You call it
we saw the COVID crash. Sorry.
COVID crash.
We saw the COVID crash. How many retail investors, saw their retirement portfolios come down, sold stocks, whatever? How can retail investors use these option-based ETFs to kind of manage volatility? Do you have specific ETFs that take advantage of volatility in the market?
I think, volatility is such, so the answer is yes. The first way you take advantage of it is always have the risk managed, right? One of the reasons we hedge is because I don't know when there's going to be one of those that comes out of the blue. Like I remember in January of 2020, I was like, it's going to be a flu. And then next thing you know, right, fastest market decline came out of nowhere. VIX shot over 80, right? It was a really volatile, scary time for investors. So the way that we like to manage risk is not more about market timing, but is having a portion of your portfolio in something that's hedged, right? Whether it's a buffered product, we have a hedged equity strategy, ZHTG, things like that are out there as well that you could just have as kind of that core piece of your portfolio to manage the risk ahead of time. I always like to say the only thing you could manage is the risk you take. And so when you have unhedged stock, you realize you always have the potential for a 2022 or a 2020, even 2018 Q4 was a little nasty as well. Yeah. So like those types of things, I would say that's a general advice we give to investors. But, you can use the volatility market to kind of read the tea leaves, right? When you look at where the VIX is today or the VVIX, the market is projecting low volatility for the foreseeable future. I would tell you, as somebody that's been hedging for the last 14 years, it's been rare to see hedging cheaper, meaning the cost of protection hasn't been this low in a long, long time.
Right, which means the market's just not expecting anything. The VIX is
that's a fair way to say it. Yeah.
I mean, I know we're coming up on time here, Jay. I mean, I'm sure Jason.
I want to know at the Fed. Do you think the Fed's going to cut 3 times this year?
I don't.
Once,
I think we
twice?
get one.
Once. That's what Waller came in last night and was talking about one cut. Jay, I was going to say, I'm sure Jason and I have, could talk to you for another 3 hours. So this might just have to be part 1 of our conversation.
Well, because I love this. The problem is a track record. It's in the sub-advising thing, but I love this idea of treasuries with options.
We'll go buy some.
I'm going to buy some, but I don't know why. I've been looking for a solution like this because I own T-bills and I feel like there's an option strategy because they're, direct index investing, right? Where you can take tax loss harvesting. I don't do it right now, and I'm going to do a little bit, I guess, but that's part of the business of, how you can get better returns. That's what it seems like you're doing with this product. Now, SoFi,
I would just say it's a different set of returns, right? The correlation to the markets are low. It kind of does its thing regardless, right? To make money in 2022, but last year only made 9, right? So it's one of those things. It's going to march to its own drumbeat.
Yeah, and but my treasury fund made me 5.5. So 9 would have been 9.
9 would have been better than 5.5. That's true.
Wait, one more thing at that. So it's a SoFi fund. You work with title on it as well, and they're the what part of it? They manage the model, or they manage how does it work?
They're the administrator on it. It's their platform. It's their trust. All ETFs and mutual funds have to sit within a trust structure. That's just the 1940 Act process has that scenario. They're also the advisor, so they have the right to hire the sub-advisor like us, right? So they're the ones that say, okay, even though SoFi came to Title and us together to ask for this, really technically we work for Title and Title works for SoFi in that scenario.
Aaron Bree, I bet you didn't know. Think of this question. Ready? So do ETFs ever close down?
Sure, all the time.
Okay.
The short Jim Cramer one did.
Okay.
Shut that one down.
So what happens in that scenario? How does it affect an investor?
Yeah, I believe the investors, the fund closes and their closing NAV, the value of the fund, the price of the fund gets distributed as cash right back to the investor that held the fund.
Got it. Okay.
Well, how you were talking about how you guys are hired as a sub-advisor, that's how you, when you're talking to, potential big investors, that's how you should pitch it. Be like, look, I only keep this job as good as the fund does. So then you should be in pretty good hands, right?
Look, that's always the risk when you're the sub-advisor. It's a little bit of a pain to change out the sub-advisor, but if we do a bad job, you're right.
High switching costs, yeah.
Yeah, of course. There's proxy votes and stuff like that.
So I think we need to bring Jay back on in 2 months.
2 months.
Or maybe he'll come for our draft party in a month, but I'm going to make
Maybe you'll see him down in Florida.
Maybe he'll pick me up at the airport. Maybe he'll find the boat and drive us down.
I'll get you a boat.
Yeah, get us the boat. I got to figure out this boat thing. But I'm gonna make an investment in this. After this thing, I'm gonna make an investment, and then we'll do an update. And
I get a finder's fee, right?
I wish I knew about it last year though, because my return would have been doubled. Yeah. Well, but I guess I'll do it.
Learn about it now. Be happy we're learning about it.
You're in now. It's okay.
I won't do 7 digits. We'll go smaller and we'll figure it out.
Well, Jay Pestrichelli, again, the CEO and founder of Zega Financial. Jay, it's been awesome to learn more about your options-based ETFs. Again, options, ETFs, 2 of our hottest topics here at Benzinga. You're like the expert in both these areas. So we gotta. Are you down?
We got a twofer.
Are you down to come back on, or did we scare
Absolutely,
you off?
guys. No, this is great. Love the
All right.
conversation. It's
Awesome,
amazing.
Jay. Well,
All
enjoy the rest of your day.
Thank
Enjoy
you.
your vacation too.
Thank you.
Thank you.